No, not really. I suppose, obviously people focused on the substantial time before we'll see the rate hike after quantitative easing ends next month. Obviously the Fed is getting a little bit more hawkish, if you like, if you look at just purely the dots of Fed rate forecasts going forward. So 20 basis points increase in their expectation for year end next year Fed funds target. So, if anything, they're still getting more bias towards, stronger data, potentially slightly building inflationary pressures, and that's leading some to be a bit more hawkish. But overall, for now, Goldilocks scenario continues. Inflation remains benign amongst a still strong economy, and that's pretty healthy for market risk appetite. Well, first of all, I think the idea that raising interest rates leads to sustainable concerns for the stock market is probably misplaced. It can lead to short-term volatility as we get close to that decision actually being implemented. But I don't think it's actually a sustainable challenge for the market. So we believe that the bull market in equities globally and still in the US is likely to continue for another 2 to 3 years from here. But coming back to your point as to when will they start moving interest rates, we're still looking at Q2 next year. And indeed, if you look at their new projections for end next year, it's basically saying if they start in June, then they'll have to hike at 25 basis points at every meeting thereafter to meet the median expectation for Fed funds target. So probably the bias, if anything, is to the start date being a little bit earlier, maybe the April 30th meeting. As I say, though, we don't think that's necessarily too damaging for stock market environment.